Hello and welcome to today's premium account market update for December 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have over 18 years of experience in the financial services industry and the licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities. We roll through the ASX top 50. We look at, in particular, FY18, FY19 earnings trends, technical trends within the top 50 stocks. We look at portfolio allocations and conclude with a short-term market outlook. The premium account services, where we work in partnership with you to manage your equity portfolio. We have a mandate that sees us focus on top 50, occasionally stocks outside the top 50 but still within the top 100. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, generating above average cash flow through the use of call options to enhance the return while still seeking capital growth. And it's all in a strict investment mandate, suitable for self-managed super funds, and importantly, the assets remain in your name. If you'd like to know more about the service, please contact me on 1300 614 002. Moving straight into a graph of the domestic market and the relevance of the correction that we've had, which, depending on what global index you're referencing, is somewhere between, say, 10 to 14% correction. The XJO is approaching 50% of the last significant range that it had. So if you think about in early 2016, we're trading around 4,700 points. We rallied up to around 6,400. We're now back at around this 5,500 level, which is ultimately where I think the market consolidates and moves sideways. That lends itself to an environment where I think we're in subdued earnings growth environment, and we're probably not going to see any type of PE expansion like we've seen over the last few years. So I think you need to think about how to deliver returns in a flat to sideways market, and that's certainly where call options come into play. So what we're going to do now is we select the ASX top 50 watch list here. We get the it will actually sort it alphabetically, so we'll start with AGL at the top here, and I'll start toggling through these and just share with you a combination of a bit of fundamental information with the technical signals around the algo engine. So AGL's been making lower lows, lower highs. It's under current algorithm buy conditions. But on this rebound that we've had at the moment, we're starting to run into what we see as sort of full value for AGL. So as US interest rates have come back down over the last 4 to 6 weeks, the yield sensitive names, so when you think about that, it's real estate investments, trusts, it's utilities, it's infrastructure, they're yield sensitive. They're the ones that have performed well, and that'll be a focus of today's recording. So in the case of AGL, if you own it, now's the time to start thinking about selling covered calls and turning that 5% dividend yield into 10 to 12% cash flow. Now, Aristocrat's a high growth, high PE name, and this is the area of the market there that's endured the heaviest selling pressure. The range that I've highlighted on screen for Aristocrat is effectively between $20 and $22 is where I think ultimately it starts to find some buying support again. So have a think about that, maybe make a note, and that's one that you want to track on your watch list. So Aristocrat between $20 and $22. Amcor's under algorithm sell conditions. They've got the acquisition of Bemis Group, which is their main US competitor. It'll see Amcor eventually delist on the ASX and be domiciled on the New York Stock Exchange. I think the cost synergies that'll come from the Bemis acquisition underwrites the downside risk to Amcor, but obviously if there's any sort of ongoing slowdown in the global economy, it's probably not going to be great for earnings growth for Amcor. But on historical PE basis, the stock's starting to look pretty reasonable value. So mindful that it's making lower lows, lower highs, but I think there is scope in the new year for Amcor to trade higher than where it is at the moment. AMP, we under algorithm sell conditions, we have the sell signal there at 330. ANZ, so one of the few banks that's under buy conditions at the moment. So if we think about the Aussie banks, they've really corrected on average around 40% from where they were 2 years ago. ANZ's actually holding up okay relative to where its low was in February, and we'll just reference that as we go through some of the other names within the banking sector. APA Group under sell conditions at the moment. So not doing anything there. You may recall there was a takeover bid from a Hong Kong group here. So APA gas pipelines, and it was knocked back by the Australian government. And I haven't sort of read any sort of further. Sometimes you can see sort of a proposal to break the company up and only acquire certain parts of it. I haven't seen that play out yet. So that for the moment, we're not doing there in APA Group, but we'll continue to sort of look for that news flow around how that takeover might be restructured. ASX Group, so it has been growing earnings 5 to 6% on 3.5% dividend yield, trading on a very high PE valuation relative to its historical average. There's an opportunity to own it, sell tight covered calls, but not looking for much in the way of capital growth over the next 12 months. AZJ, so we had owned this at lower levels. At $4.40, we've sold covered calls over it. We've gone out a fair way there into June, but we're looking to capture the February dividend. We think around $4.40 is about full value for AZJ. So the added income from that call option combined with the dividend delivering us 10% cash flow. BHP, so within the resource space, BHP and South 32 are our preference. Owning BHP here and selling an out of the money covered call. You're getting exposure to the upcoming dividend streams and the added option premium. Again, you're turning that into a 10% cash flow, so that's our preference there for BHP. Brambles, we got the pending spin-off of their plastic pallet pooling business in early 2019. $10 looks to be reasonable value. There's a price gap there from a technical standpoint that's been filled. So buying it here and maybe looking to sell calls at $10.50 or $11. Not looking for much in the way of capital growth there due to the general slowdown in the global economy. CBA, lower lows, lower highs under sell conditions. So if we look back 2 years ago, CBA was at 95, now it's at 68. Unlike ANZ, it's now making new lows, whereas sort of that low in 2016 in ANZ, you can effectively the structure in CBA is more negative than it is in ANZ. Lower low, lower high. Even recently, we've had the sell condition there at $73 and a little bit cautious. It'll be interesting to see over the next 12 months how long it takes for buy conditions to appear or to develop in some of these oversold banking stocks, but we're not there yet. Cochlear within the healthcare space, it's under algorithm buy conditions. You can see the history of the signals has delivered very good results here, highlighting the higher-low formation. The last signal was back at around 160. It's really moving sideways at the moment. It's not stock that we do too much within client portfolios. Now, Coles has been listed for about 2.5 weeks, trades on about 16 times earnings versus Woolworths at around 21 times earnings. The issue that Coles has is whilst it was in the stable of Wesfarmers, they underinvested in technology and store refurbishment. So as a listed company, they're going to come into a period of higher capital expenditure, which I think will weigh on the share price. So I'm only a buyer of Coles on the pullback, somewhere back under $12. I think there's a trading opportunity. We picked it up on the lows here. We got out of it at $12.50. If we see it back down around $11.75, happy to think about buying it again. Computer shares, still cautious on this name. Up here it was trading 21, 22 times earnings on a 2% dividend yield. Through this period, the company was delivering negative earnings growth. I sort of question the quality of the cost savings and the earnings growth through this period that's really driven by expectations of increasing US interest rates, higher US dollar, etc., which provided tailwinds. So I'm cautious on Computershare just from a fundamental point of view, but we'll continue to review that in the months ahead. CSL back at sort of corrected from 230 back to 170, 180. I think it's a safe opportunity as a buy right in the market, but I don't see CSL rallying up and taking out. I think at this point the stock was trading almost 30 times earnings, and I think the market's appetite for high PEs have really diminished. And whilst CSL should deliver about 10% earnings growth, I just don't see it trading back up onto those lofty PE ratios, so it's likely to trade sideways. Caltex, this has been a bit disappointing. We've been looking for commentary out of the company about maybe splitting up the real estate investment trust side of the business from the retail petrol stations. That news has been pretty slow in playing out. If we look at it from a technical standpoint, Caltex had a lower high formation there at $33, and it's corrected about $6 since then. So the algorithm model there did a very good job of getting out of that position. Dexus, so this is an area of the market that's really worth sort of pausing and thinking about the strength of, which is the real estate investment trust. So again, as we've seen US interest rates fall, these yield-sensitive names have done very well. So Dexus has been a strong performer in that regard. Fortescue under sell conditions. So history suggests that these are often right, or at least rather than owning Fortescue, you're better off owning BHP and South32. If you're looking at short opportunities in the market, think about it with a stop loss above sort of these levels that I've marked out there. Goodman Group within the property trust sector, this just continues to go from strength to strength. It's compressed down onto a very low dividend yield, so about 3.1, 3.2%, which is probably a full percentage or 200 basis points more compressed on the yield than the other real estate investment trusts. So the market really willing to pay a premium for the slightly higher growth rate that Goodman delivers, which is about 6 to 8% opposed to most REITs somewhere around 3 to 5%. GPT Group delivering about 4%. Earnings growth per annum, just over 5% dividend yield. If you own it, sell covered calls to complement the return. Insurance Australia Group, fair value, I think, is probably all you could come up with here. The company's likely to grow earnings around that 5 to 6%. You really need to sell a covered call. We don't see too much in the way of upside. James Hardie, across the whole building spectrum, whether you look at James Hardie, CSR, Boral, they're all under pressure at the moment. James Hardie's a high PE name that's corrected, searching for support here. You can see I've marked this out as value, but you can hardly get excited about the technical picture there. The selling looks quite sort of relentless with each sort of little bounce, at failing. But look, there's roughly sort of 50% of sort of the recent rally over the last number of years. Has corrected a long way from 24 back down to 15. We'll just have to be patient and wait for a more bullish support there to develop in James Hardie. And likewise with Lendlease. Obviously, Lendlease has had the issue where they've had a roughly, I think the number is around $600 million overrun in their engineering project division. The company's reviewing as to how they deal with that division going forward, whether they spin it off. But also behind that, there's some negativity, obviously, within the property, in particular residential units, and some risks around what the settlement defaults look like in some of the projects that Lendlease has globally. They own the best, so their strategy is to develop units within sort of major city centres. So they own sort of the best quality property development portfolio, arguably, but there's still sort of a lack of tailwinds there to support the business. And then this latest issue around the engineering division, and the investors still don't have clarity as to ultimately what the company's strategy is with that division. And you've seen, I think, that negativity from Lendlease's engineering business flow over to Downer EDI and CIMIC as well. The market's a bit sort of skeptical and cautious across that whole sector at the moment. Mirvac Group under sell conditions. So if you're looking for shorting opportunities, I think this is one to keep on your radar. Again, with maybe a stop loss above 240 there, but you could have a look at that for it sort of remaining under pressure below that sort of 230 level there. Medibank, put this one on your watch list. I think there's a price gap down here to 225. They lost the Australian government defence contract, which I think was worth about $30 million profit to them, which is equivalent to about 7% of the company's profit. So a substantial hit, and that's what's caused this fall from really sort of this 270 level, or down, so down to where we are at the moment, 230. If we see it into sort of the 220 range, I think the value support there is substantial. The stock's back on sort of a 4.5–5% dividend yield, or at least 4.5% yield, and I think that stabilises the share price around that 225 level. So keep that one on your watch list. Macquarie Group under algorithm buy conditions, growing earnings at around 15% per annum. If we assume in a tough global macro environment, the stock really tracks sideways. It's one that you can think about as a buy right at the moment. NAB, so within the banking, we've seen sell conditions here at $30, further sell conditions here at $29. If we think about this in the context of the structure versus ANZ and CBA, it's probably most similar to CBA. It's fallen from $40 down to almost $20, so it's almost a 50% correction. Not quite, about 40–45% correction over the last 2 years. The risks here with NAB is that it looks like it can actually trend a lot lower, and the structure, you can see it's taken out the prior low there, whereas ANZ had a slightly more positive structure than what we're seeing here. And maybe the argument is ANZ's a little further down the track with some of its restructuring and investment in technology than CBA and NAB. Newcrest, so gold generally has done better over the last week or so, as a combination of US interest rates coming back, US dollar softening. The concern here with Newcrest is it's under algorithm sell conditions, and our preference is Evolution and North Star, which are two stocks that are in the model portfolio and both have algorithm buy conditions. Origin Energy, we had the sell signal here at around $8.70, stock now $6.85. So whilst the Origin is going to reinstate their dividend next year, so you, as an investor, you'll receive 20 cents of dividends, 10 cents in the first half, 10 cents in the second half. In FY 20, they're looking to reinstate their full dividend based on free cash flow. So you may see that dividend jump up to something more in the order of sort of 40 cents plus on an annualized basis. And that'll all be subject to how oil prices perform. But even though it's under sell conditions, I think probably Origin's fairly close to support between sort of say $6 and $7 is a likely range there. Orica under algorithm sell conditions here at $18.56, or 18, let's just call it $18.50, and it's likely to sort of continue to underperform under that technical pattern. Oil Search under buy conditions, so Oil Search, Santos, Woodside Petroleum, all under buy conditions. We like these names. We don't expect any sharp recovery from where we are at the moment, but I think they bounce along sideways and find support. Qantas, we're cautious on this name. It's rolled over, made a lower low, lower high. It's under algorithm sell conditions. We've got resistance there at 620. You want to be on the short side of that whilst it stays under 620. QBEs, we've had this buy signal here. We had marked out and discussed on the blog that around $10 was a level to take a look at this. Still a bit cautious that the broader structure here is negative, but it's just a matter of, has this flattened out enough? Have we started to see a higher high formation, a higher low? But certainly a break back below 930 would be very negative for QBE, and it's really going to be driven by the upcoming earnings result there. But then the last earnings result, there did appear to be the early signs of some sort of turnaround and cost saving starting to play through to more stable earnings. Ramsay Healthcare, it's been under sell conditions for a while, had last ones here at around $70, further confirmation there at around 57, but fair value starting to materialize here. The stock's corrected from around 26 times, I think, PE, probably back down to high single digits. It's now getting back into a range of sort of 2.5% to 3% dividend yield. So looking for it to consolidate, but one for next year to watch for the algorithm buy condition to play out there in Ramsay Healthcare. Rio under algo sell condition, so we're cautious there on Rio. Again, our preference is BHP and South 32. South 32 under buy conditions. We've got supported around $3 here, and we'll willing to sort of to have exposure to that and run a covered call strategy to enhance the returns. So Centre Group's under algorithm buy conditions. So this is an example of a real estate investment trust that's benefited from the pullback in US yields. Centre Group's doing a share buyback, trading on about a 5% dividend yield. I think these REITs are getting a little bit expensive. Given low levels of earnings growth, the rally's been supported by retracement in US bond yields. So owning them here and selling tight covered calls and turning sort of a 5% yield into a 10% yield makes sense. Stocklands is under algorithm sell conditions, so we're cautious there on Stocklands and Mirvac. Sonic Group, probably lacking in the way of earnings growth. The company downgraded from 6 to 7% earnings growth to 3 to 4% earnings growth. Stock's on about a 4% dividend yield, owning it here and selling tight covered calls, delivering 10% cash flow. Santos, so again, referencing Oil Search, Santos, Woodside Petroleum, all on under buy conditions. In the case of Santos, there's a price gap here down to 520. So maybe buying some here and more down at 520, or just being patient and looking for the support there to kick in at around that 525 level. Suncorp in the model at the moment, and I've just flagged that maybe around this 1250 level might be an area just to keep an eye out for there in Suncorp. Sydney Airports, so we own this from lower levels, moving into the sell range at the moment. So when you think of Transurban, AGL, Sydney Airports are probably, in the real estate investment trust, they're all interest rate sensitive. I think as Sydney Airport gets into this sort of $7 to $7.50 range, you're getting into full value. The stock's on a 5% yield, and look to sell covered calls there to enhance the return. Transurban up against resistance, being supported by lower bond yields at the moment. If you own it here, look to sell covered calls to enhance the return. Telstra benefiting from that sort of lower interest rate environment, viewed as a slightly yield sensitive name, Telstra. Even allowing for a further cut in the dividend over the next 12 months, we have Telstra now trading on a forward dividend yield of around 5%, and that's assuming the dividend gets cut from 22 cents down to 16 cents. So to me, most of the bad news is priced in. We're about 18 months, 2 years away from seeing the infrastructure side of the company spun off into a separate listed entity, and as a Telstra shareholder, you'll end up a shareholder in the infrastructure co as well as the traditional sort of Telstra retail business. That should help to unlock some value. Treasury Wines, we like this name. Corrected from, again, 30 times earnings back to something more reasonable where we are at the moment. I think we have to give sort of the support range a reasonable margin of error here, given the volatility in the market. So I've said sort of on the downside, weakness maybe down to 1250 to $12, but certainly around where we are at the moment, sort of $13.80 to $14 looks attractive as well. So we don't mind Treasury wines. Unibail, so this is the company that acquired Westfield. I've gone through the earnings results here, and it's hard to identify where the underperformance is coming from. And a couple of factors could be playing into the sell-off here. Obviously, we've got the problems in Italy with them providing a balanced budget that the EU's happy with. You've got problems in France that we've seen with rioting around increased taxes and other. So the instability in the Eurozone is, I think, playing into investor concerns here. You've got a lot of Australian shareholders that held Westfield shares that don't want the Unibail. You've got fund managers that are quitting the stock. But with the stock on about a 6% forward dividend yield, I'm looking for the February earnings result to actually support a higher price here in Unibail. So to me, the stock looks oversold, but it was something that I saw value at higher price points. So I'm surprised to see it down where it is here, and looking for 2019 to be a better year for Unibail. Vicinity Centres, not doing there at the moment. Westpac, so if we have a look at this relative, so a little bit like CBA, like NAB, Westpac's making lower lows. It's corrected a good 40% from the highs 2 years ago. It's under algorithm sell conditions. We had the last sell signal here at 28, now trading 24. So a lack of positive momentum there. Wesfarmers, so trading on about a 5% dividend yield, about 16, 17 times earnings. So you want to be selling a covered call over Wesfarmers to enhance the current dividend. And there we are, back to the index. So let's bring the XJO up on screen, and we'll also have a look at the Dow Jones. So where we are at the moment is the market's still in a negative technical structure. We're waiting to see whether the 50% retracement provides some level of support for the market. When we think about sort of things at a global macro level, S&P 500 probably is not going to deliver 10 to 13% earnings growth like it did over the last 12 months, and obviously that's true underlying earnings growth, because whilst the headline earnings growth was 20-odd%, 7-8% of that came from tax cuts. Third out of that 13%, you probably have to allocate 2 or 3% to share buyback. So maybe true earnings growth was running 8, 9, 10% type numbers, and I think we start to see in January sort of the first read of S&P 500 companies, and the volatility in the December quarter and the slowdown in China and Europe and what impact that has on S&P earnings. So the market, it appears to me, is repricing for really sort of somewhere between 0 to 5% true underlying earnings growth for the S&P 500. So even though the price is corrected, the PE stays at around 16 times earnings. If earnings fall to where it, to that 0 to 5% range, so that's what the market will really start to focus on in early January, is that the first lot of S&P 500 earnings is an indication of how much this global slowdown has impacted. So to me, the market's started to sort of insure itself against that lower earnings rate. Probably we start to stabilize around where we are at the moment and move sideways until we get through to that January earnings. And with any luck, it's not as bad as what the market's fearing, and you may get some mild level of recovery from it. But the environment's clearly changed, and we're not going to see that level of PE expansion and earnings growth that we've seen. So you need to think about a strategy for a stock market that's moving sideways, and the covered calls is a great way to deliver the extra returns. Thank you for listening in. If you'd like to know more about the Investor Signal service, please don't hesitate to call me on the number on screen there. Thank you.